Welcome back to Fundraising on the Go podcast, the podcast brought to you by PwC Next Level, where we unravel the mysteries of fundraising for startups. I'm your host, Otito, and I'm excited to have you join us today for the first of 2 bonus episodes of the Fundraising on the Go. Today, I'm joined by Lucas Stoops, a partner within the venture capital firm 6 Degrees Capital, a young VC firm backed by seasoned investors. Your portfolio goes from seed startups to Series B scale-ups, mostly fintechs and software as a service companies based in Europe. Welcome, Lucas.
Thank you. Thanks for having me.
Thank you. Can you tell us a little bit more about 6 Degrees Capital and why it was created and how it was created?
Absolutely. But basically, it was the 4 of us, Thibaut, Wouter, Philip, and myself, who had a passion for technology and for investing. And around 7-8 years ago, we decided that the opportunity in Europe is ripe. We saw a lot of great companies getting to market, and we thought there is place for another good VC investor. So we started investing together. And basically, we're up to a 3rd fund now. We've invested 2 funds already. The previous fund was 100 million in size. We're now raising a 150 million fund. We already did the first close, so we are investing already from that fund. And yeah, for the past 8 years, it's been a great ride, and we've made very, very good investments in my view, and we look forward to the future on that front.
Okay, that's really, really amazing. So you're not so much of a young VC after all. You have a lot of experience in this game already.
Yeah, within the VC industry, 8 years is a long tenure. We do tend to see that the VC scene itself in Europe is relatively young. If you look at the US, sure, Sequoia is 40 years old, but if you look at when the big, when the mass amount of VC started to hit the market, it's actually only 20 years ago. And I think in Europe, I would say it's 10, 15 years ago. So within the VC space, we've been seasoned investors, but yeah, we look at the firm for the next 20, 30, 40 years. So in our journey, we're still early.
Okay, that's amazing. So you've been doing this for quite some time right now. Have you always wanted to be a VC? How did you even get into venture capital in the first place?
That's a good question. So I've always had a feeling I wanted to become an investor. And so to that extent, when I was at university, first studied at the University of Antwerp, I co-founded the student union together with Christophe and Maarten called Capitant. And Capitant basically is like the ISEC for finance, if you want to call it. So across the 5 cities in Belgium, we focus on the financial markets, on investment banking, or on investing. And basically setting that up allowed me to get an internship with JP Morgan. And so with the JP Morgan in corporate finance division, first on the ECM side, basically meaning you're doing IPOs. And then my second stint there was in TMT, technology, media, and telecom, where I did M&A. I lived in London for 3 years there. I lived longer in London, but I was with JP Morgan for 3 years in London. And basically, I met Philip there, who were now together at 6 Degrees Capital. He was in a very different division than I was, but for some reason, we got along very well. And at some point, I remember very well in the summer, he took me apart. We went for coffee, and he said, "I think about setting up a VC fund, and quite like you, like maybe you should join at some point if you like it." And I said, "Well, sounds like music to my ears." So a couple of months later, I did join, and that's where we are today. So always knew I wanted to do investing. Always had a passion for technology. Did I know from when I was 16 years old I wanted to become a VC? Well, I don't think so. But rolled into it, if I may call it like that. And yeah, since then, never doubted that it's the right choice for me.
And was it easy to start a venture capital fund?
No. But I think setting up any business is tough. I think in venture capital, you are a financial company, financial services. So you do have regulation, you do have a bit more hassle, I think, to set it up. You do manage money for other people. It comes with a lot of responsibilities and a lot of trust you need to create with your investors. So I wouldn't say it was easy. But yeah, in the end, if we look back, we would have done it. Definitely done it again, but definitely it was much tougher than we anticipated. But so far, so good. I mean, if you have good investments and you have the trust of your LPs, then it becomes a lot easier. And that's where we are today. So we feel quite comfortable now, but it was definitely a very interesting ride. And look, honestly, if people ask me like, what do you like so much about venture capital and 6DC? But I always say two things. First of all, I like what we do, the investing in companies. But also secondly, we are building a firm ourselves with 6 Degrees Capital. We need to hire the right people. We need to hire the best people that we can. We have our own operations to take care of. We have the LPs that we need to convince that we are the right party for them to invest with, and we need to convince the founders that we are the right investor for them. So we have a lot of stakeholders to manage, and I like that a lot as well about the job.
Very, very, very interesting. Like you mentioned, you are also investing other people's money. You're a financial services company fundamentally. Yes. And that means you have a big responsibility to invest LP's money into startups. So I guess one of the things that are kind of interesting is that you have to choose the right startups to invest in. And what's the kind of criteria do you use, or what do you look for, when trying to choose the right startup?
So obviously it's a mix of things, but maybe to give a bit of context, I think, there are what we put in our investment memo, and then of course there are a bit more soft factors, and I'll get to that in a second. I think for us, we put a lot of emphasis on customer pain. Like, are you really solving a big problem? If I can give two extreme examples, maybe, Microsoft 365 or Google Suite. Well, that's a product, everyone needs it. You need it to operate it, your computer. So that is a clear market need. People need this. On the other end, maybe another extreme example is what we saw with Gorillas and Get Here, the 10-minute or 7-minute or 5-minute delivery. Well, is it a nice service? Sure it is, but is it that necessary when things go south? Well, I don't think so, and you've seen that as well. So try to be really where the customer pain point is the hardest. And so we really put a lot of emphasis, and we do ask founders to clearly explain us, what problem are you exactly solving for the client? Why does it make the client's life a lot better? And not only cost, it's not only better cost, it's more efficiency, it's better viewability of their own data, or enabling sales. So really focus on customer pain point. It's really when, if you discuss an investment case at the investment committee, I think the first half hour is nothing else on this, just to really fully understand it. That translates in, of course, to what is the proposition of the company? What is the product? How are you trying to solve this customer pain? We really need to be able to understand the product in a very simple way. Of course, a product typically on a technical side is very, very complicated. But if you need to explain it, hopefully to us, it's very simple, that we can clearly understand, okay, customer pain, and you are solving this way. Then, of course, there are many other factors that play as well. The market. How big is the market? How good is the market? Is the market timing right? There is a very important thing that you call market timing. And basically it means like, sure, your solution might be very good, but is the market ready for it? And so a lot of these factors have to play in together. What is, of course, also very important is your distribution. Are you going direct? Do you use partners? Is it a mix? There's no right or wrong here, but it's trying to understand how it works. How do you make money? How do you price the product? Does it make sense? Traction, of course, very important. And people always ask us, do you have a number in mind that you need to see before you can invest in our company? Typically, the mantra is 1 million in ARR for a Series A company. We always say we need to see that there are early signs, or ideally that it just solved is product market fit. And again, that ties back to the customer pain and the product. Can we see, okay, we have a product that is now generating revenue. If we invest 1, 2, 3, maybe 5 million into a company, will this money be used to really scale the operations? At seeds, people invest in a dream, and people invest in a team, and more or less broadly do they get the market and so forth at very early stage. At Series B, it's all about the metrics. Do the numbers make sense? What is the unit economics and so forth? Series A is right in between. We still need to believe in the dream, in the team, but we do have metrics that we can look at already. And we are trying to understand, okay, do we have enough confidence that if we invest 5, 6, 7 million at the round, that the company will raise its revenue, 100, 200%, a couple of years behind each other. That's how we are trying to get an understand of traction. So traction, we don't think about it in absolute numbers, but more in product market fit. Then, of course, we look at competition. Is there a lot of competition out there? And is the product differentiated versus the competition? There's always competition. There's no doubt about it. You have so many companies that say, yeah, we have an unfair advantage for whatever reason, or there's no competition. Well, it's never the case. Maybe today, but definitely not next year if you're doing very well. So we always trying to understand, okay, the competition, how do they play out? How do they work? Can we win? And well, in many markets, there's not one winner takes all. There is space for multiple players. So trying to understand that. Then, in my view, next to customer pain and product, the most important thing, of course, is team. It's funny, when talk about entrepreneurs, typically people say there are good entrepreneurs and there are bad entrepreneurs. Give the extreme example of course, in Elon Musk. It's no coincidence that, well, maybe not everything, but most of the things that he touches become really, really big. And so we really try and understand, okay, can this founder make this a really big business? Because there is a big difference between setting up a business and then really scaling it, going from a startup to a scale up. And of course, you never know. But we're trying to assess, okay, is he very methodical in his reasoning? Does he answer to the point? Most importantly, can he hire great people around him or her? Because you can't build a business alone. You simply can't. So a lot of soft factors, and that's what I alluded to in the beginning, a lot of soft factors there where we're trying to understand, okay, the founding founder or founding team, can they make this a really big business? The last thing, and then I'll maybe pause, is the round. Yeah, it kind of needs to make sense, of course, when a company does $1 million in revenue. Well, if the valuation is 200 million, that obviously doesn't work. So we're trying to understand the round dynamics. The amount of money the company raises doesn't make sense to the valuation that they more or less have in mind. I presume we'll come back on that later on valuations. And then, of course, trying to understand the cap table, meaning how does the shareholder structure currently structured? Does it make sense for us to invest? All of this has to come together, everything I've just spoken about, but obviously there is never a green light on all of these things. Some of the things are non-negotiable, of course, like the team, the product, the customer pain. All the rest, look, if something's the orange, well, we can still go ahead. It's never super clean story. You almost never have it that everything shouts, this is the one to go for. But I would say those are the things that, at least from our point of view, we will extensively write about, we will extensively discuss with the team. So I would say customer pain, the product, market, distribution, business model, attraction, competition, team, and the round structure.
Okay, that's very, very interesting. I think while you were speaking, you sort of emphasized a lot on the customer pain.
Yeah.
And I wanted to understand, like, how do you assess that the company is actually really solving? Because they could bring up this many statistics about, oh, this is what the market needs, this is what is going on. But how do you really get to the roots that this company is actually solving a real problem?
Good question. There is no clear-cut answer to that, but we get many hints and pinpoints from a discussion with the company. Yeah. First of all, let's put it very simple, and that ties into the traction section. If you have a contract with ExxonMobil, huge company, and the global contract is a 50K contract, well, that doesn't seem like a big problem for ExxonMobil and that you're trying to solve. Yeah. Now, on the other hand, we've seen also companies just out of the gate that sign a 1 million contract for HSBC UK, only the UK end. Well, clearly that's important to HSBC. So, for example, an indicator. Yeah, also a lot of first principle thinking on our end. Like, okay, the market, we do see a lot of companies. So we see 5,000 companies a year. So we do get a sense of what are some of the problems in the market. And so really trying to understand, okay, from a first principle thinking on our end, does it make sense what the founder is saying? And then secondly is, as I mentioned, the traction, speaking to customers, speaking to people in the industry, speaking to potential customers, not their current customers, but to potential customers. And in that sense, we can get quite a good understanding on how real this problem really is. So there are many, many factors we look at. And we really try to indeed, first principle, try to get as many information as we can. And in many cases, you already see it in the current client traction. But, a good example is we wanted a company and they had one big contract. It was one big contract. It was a contract of 750K, if I'm not mistaken. And based on that, they said, well, look, we've definitely found product market fit and we solved the customer pain. Well, might make sense, but we figured out that we spoke to many of the other potential clients and they said, yeah, it's very specific to that client. that big contract. And so it's a customer pain for one client, but not for the market. And so trying to get as much more information as you can. That's how we get to quite a good understanding of how real the customer pain is.
Okay, that's very interesting. But with Series A, obviously there's a little bit much more information and data and the traction, but you also do seed, and I can imagine that might be a little bit challenging. So would you just say speaking to more customers is one of the ways to sort of identify what the customer pain is?
Yeah. It does. And at seed, indeed, but the risk profile is also very different at seed. We do small tickets, the rounds are smaller, the valuation is lower. There's more uncertainty, but normally the price also reflects that. So I wouldn't say the investment process on our end is different, but we do factor it in. We do factor it in that if we put a 1 million check in a company, well, there are we can take a bit more risk, and maybe risk is not the right word. We can live with a bit more uncertainty.
Okay. And another thing, when you were describing on the criteria you're looking for, you talk about how the market, and there's this usual thing that a lot of startups do where they have like a TAM, SAM, SOM in their pitch deck. And what really convinces you that the market is large enough, because it's become cliche right now to have these metrics right now that they take from Google. But what really makes you believe that the market is actually huge?
Well, since this is a series for entrepreneurs, I would say, first of all, if you size the market, well, take the segment that is relevant to you. We've seen so many pitch decks like, we're tackling the hospitality industry, which is a 1 trillion market.
Yeah.
Sure. But then not your product. So what I would recommend is, the best things we've seen is that you clearly outline to the investor how the market looks like. I mean, we just 3 weeks ago, we had a company and they did a fantastic market analysis. It was a spreadsheet where they per country had a simple build-up. It was 30 lines of Excel where they said this is the total market. This is indeed what we think is addressable. This is what we think is addressable for us in the next 1 to 2 years. It was a very simple calculation. And we could see that, for the Netherlands, it was a 300 million market. For Germany, it was a 1 billion market revenue I'm talking about, that they could address. Well, that was very simple for us to understand, to read through it. And we thought, this makes sense.
Okay, that's very interesting. So you mentioned, how different entrepreneurs put a variety of things on their pitch deck. What makes the pitch deck stand out to you? And also, you also mentioned something where, you want them to provide as much information as they can, analysis that you can, to help you make a decision faster. But there's like this thin line between having enough information and having too little information. What is that pitch deck that stands out to you? What would be the perfect pitch deck for you? What that you like to see?
Well, so there can never be enough information, but it needs to the point and needs to be relevant. I would say if you provide data, you have to. The way I see it is 3 things: you have the pitch deck, the financial model, and then you have the data room. And the data room indeed includes the market analysis we just talked about. But let's maybe then focus on the pitch deck now. A pitch deck is for you to get a foot in the door. So it needs to be compact in size, I would say. I don't see a reason why it should be more than 20 slides. It needs to explain the problem, the product, the traction. And in our view, what we like the most is how can you make this a company that will 10 million in revenue, let's say in the next 2-3 years, and how can you get to 100 million in revenue? So make a very simple story. Why is this company solving a problem? What does the product do? And explain, please, what it does. I can't explain. There was once this famous Twitter quote from one of the partners at Y Combinator, and he said, it's unbelievable. He said, more than 50% of the decks I read through the deck and I still don't know what the company does. I know it's in insurance, I know it's in whatever hospitality, but I don't know what they do. And unfortunately, it's true. There's so many pitch decks that you read, and you're like, well, I guess, I know which industry it is, but I guess they're trying to solve this, but I think you might need to have to do a call to fully explain it. So make it very simple. Don't use all these fancy terms that are, jargon in your certain sector. Explain it very simple, and then, indeed, explain the distribution and business model. What's the current traction? What are the current clients? How do you serve them? And then, look, we internally, we always do an analysis. What's the road to 10 million euros in revenue? That's typically something we like to see in the next 2-3 years. And then, more importantly, what's the road to 100 million or 1 billion in revenue? Forget about valuation. That's something different. Talk about revenue. We need to do that exercise internally So the more ammunition you can give us there, the more we know how you think about it, the better we'll be able to do the exercise ourselves. And we know things will change along the way. You know that we know things will change. Your ideal customer will change as a thought, but give us as much confidence as you can about, okay, this is the problem, this is the product I have, and these are the reasons why I will get to 10 and 100 million in revenue. Don't make it too big and be to the point. Don't make these slides about cutting edge technology. You know, be to the point. Why is your technology great? I don't need to know that AI will solve many business problems. We know. We know. Be to the point. Be added value. Slides don't have to be fully written, but just make sure that what you write there, it chronologically makes sense. It's very simple to understand. There is sometimes in the market this perception that VCs read through decks very quickly, as in under a minute. Well, it's not always the case, but in many cases, VC do look quite quickly to your deck. So it's very important to quickly highlight the things that you think are important and can make the investment case for the VC. We do turn, of course, the deck inside out if we like it. But yeah, sure, first analysis can be short. More than a minute, of course, but it has to stand out quite quickly. Yeah? And there are a couple of things that we look at. We mentioned all things of traction and team. Like if there are enough of pinpoints that we say, okay, this could be interesting, then we'll definitely have the first call and then we take it from there.
Okay. And I believe another thing you've mentioned over and over in our conversation so far is the fact that traction is important.
Yeah.
And I was hoping you could provide also maybe some recommendations on what kind of things you would like to see in terms of traction for, say, much more early stage companies. Obviously, it feels like a chicken and egg problem where you need financing for traction and you need traction for financing. At least what can entrepreneurs start to put in as their traction early stage, especially when they start to build their company?
Well, there's a difference, of course, between what type of company you are. I think if you sell to SMEs, to smaller companies, typically those contracts are smaller, but you do have more of them and you do get them sooner. So there you really have numbers to look at. If you have 20, 30 SMEs that you serve, we can get an understanding of, why do you serve them, how much do they pay, and so forth. So definitely, just explain to us what you do with them. If you are more at the seed stage, if you are more on the enterprise clients, well, typically it takes longer to get them solved and it starts with a pilot and so forth. So explain to us very clearly what you do with them. Or many of the, not all, but many of the pitch decks just have a couple of logos and then a total number of revenue. That doesn't say anything. Mm-hmm. So I appreciate sometimes it's sensitive, but please explain, okay, if, I don't know, Carrefour is your client, then put the amount of money they pay for and what do you exactly do for them. And then, of course, more importantly, how will a bigger contract look like? So explain to us very simple, okay, this is the current traction, this is what we do for them, and this is how we could see a rollout. And again, with SMEs, typically you have quite quickly, you do have some traction already. So you don't need to overdo it in a deck, but please do more than just a couple of numbers and a couple of logos. It doesn't say a lot, but try to do as much as you can so we have a good understanding where you are.
Okay, that's great. And obviously now climate change, having a more consideration for the environment, it's something that is a big topic today. Do you have any ESG criteria that you look, or impact criteria that you look at when you assessing startups today?
Yes, of course. Yeah, ESG is important, but on the E and the SG, look, on the environment, we typically invest in software companies, so the only externality that they have is their cloud cost, I would say, the cloud compute, which generate energy, so we're quite good there. Social, typically these companies are very early and they have 10, 20, 30 employees. It's a bit too early to really take all to this factor into place. We really need to focus on getting the company right. And then governance, that of course is important. Typically we are the first institutional investor or the second one, and so we do help with the board structure quite a lot and making sure that the board structure is aligned, making sure that the incentives between all the investors are aligned. So typically we bring in quite a lot of our governance experience, and we find it very important because when things go right, it's also important, but it's definitely important when things don't go that well. And so, that's where we come in, of course. But typically, it's all linked a bit. The great founders with the great products, with the great teams, they do take all of this. They know all these things are very important.
Okay. And when you mentioned that while startups are preparing for fundraising, you mentioned that, they should have a couple of things like the pitch deck, financial models, like a data room, for example. And I wanted to understand, when you're looking at the financial model, for example, what are you looking at? What convinces you? That would be my first question. The second question would be, for early stage companies, are financial models even important or even relevant at that point in time?
Yes. So the first question, people always talk about financial modeling, but at the early stage, it's much more what we call business plan analysis. The business plan, you basically have two things. You have the revenue, how the revenue is built up, and then secondly, you have the cost structure. On revenue, we really try to understand, okay, you currently have, I don't know, just throw out the number, 100K in revenue. What are your assumptions to get to 500K or 1 million in monthly revenue? How have you built it up, and does it make sense? We sometimes see model where they just assume, we add 2 clients a month, and then next year it become 3 clients a month, and the year after 4 clients a month. Well, that's very simplistic. It could work potentially, but we're trying to understand, how is this built up? With SMEs, we're trying to understand, okay, you have the number of clients that's important, and then you have the average revenue to make from a client. Well, the average clients the number of clients that you have and that you will gain over the next year or two. Well, we're trying to understand, okay, and that ties to the cost structure. If you spend so much money, does it make sense that you can, gain so much clients? Then the second part, of course, there is the average revenue per client. Like if you say today we charge, I don't know, just throw a number out there, 10,000 a month. Next year is going to be 20,000 on average. Why? Why is that the case? Will you have more products? Will you have additional services? Will you go a bit more upstream, meaning you focused previously on small companies, now you focus on bigger companies? Does it make sense? So number of clients, average revenue per client gives you the revenue number. I'm trying to understand, okay, the build up, how does it make sense that we see? Secondly, cost structure. Very, very, very important. Over the past 3 years, it all ties into capital efficiency. I think over the past 3 years, by some investors, has been a bit forgotten. The growth at all costs, especially the last word, was a bit forgotten. The first word was very important to them, and so we focused so hard on capital efficiency, because it explains you a couple of things. It explains you again how big is the need for this product, because if you need to make a lot of cost to gain clients, then maybe it doesn't work out as the way you want it. But if you're quite capital efficient, it tells you about the fact that if you make this a big business, you can have very good cash flows, and that in the end still drives valuation. Despite the fact that we are in a business that invests in companies, that we provide them the cash to invest, and that they burn capital, as they say. But at some point, it has to generate cash. And so that explains a lot about, okay, can this become a profitable business? And capital efficiency tells you a lot about as well how management runs a business. We have unfortunately seen over the past years a couple of businesses and a couple of founders, and I don't want to blame them only because the market was definitely there to provide them the capital, but where they just didn't care about cost anymore, just spend. And we have always also over the past years have put so much emphasis on capital structure. Can you, with a 20 to 30 people team, can you already build a good business? And then if we add people in sales and product, can we see that they immediately or very soon start adding to the bottom line? That's how we look at it. So business plan analysis, the revenue, the build up, number of customers, average revenue per customers. On the cost side, what are your cost structures? Mostly is, of course, people trying to understand, okay, how is the people structure here? Does it make sense in the long run? Not only for the next year, but for the next 5-10 years. Second question was, remind me.
And then, is financial models even relevant for early stage companies?
Yes, correct. Well, definitely. We know that the revenue graph will look like a hockey stick. We know, okay? so that's fine. And please do so, because if you don't, people also ask questions. But it is really, again, trying to understand, does it make sense what you say? If you do 1 million revenue now and you say we're going to 10 million next year and 100 million the year after, well, chances are pretty low, if not impossible for you to do so. So we're trying to understand, okay, how you think about it. And also, if you say, I'm going to do 10 million in revenue, but for that I'm going to do 50 million in cost, well, that doesn't work either. So really trying to understand how the founder works, how he thinks, and again, this is, I earlier talked about soft factors that we look at, and one of the most important thing is the way a founding team behaves to us, the quality of the materials. Those two things, they tell us a lot about the success of the company. We have rarely seen that a founding team is rude or not operationally efficient or not to the point in meetings, that the data room is very bad, and that then suddenly they build a great business. It rarely happens. It's typically a combination where they're very pragmatic, to the point in the meetings, have a sense of urgency. They really want to get it done, not even today, but like in the next 5 minutes. And that also shows about in the financial model, is the quality high? It doesn't need to be complex. I think a complex financial model needs to come if the business is complex, but not because for the sake of making the model complex.
Yeah.
Best financial models are quite simple. The revenue buildup, which we just discussed, the cost structure, which we just discussed, just give us also a type of overview of people that you think you need to hire. Again, we know it will change in a year. We know that's not the discussion point. And probably we're going to challenge you, don't get me wrong. But we're trying to understand, how do you see it? Does it make sense with the current plan that you have? Does it make sense? So at early stage, yes, it's important. Becomes much more important, of course, late stage. But it's important to show how you think about your cost structure and your revenue base. And very importantly, the material you provide, if the quality is high, it is very important.
Yeah. I think you said something that really struck me, that it's not so much, yes, the content is really important, but the quality of the content is also something you evaluate as well. So this gives you a lot of information on how the team might perform, correct? Yeah. Okay.
But I'll tell you why. Because, look, raising capital, I appreciate it's not the most fun part of a founder. People don't start a business to raise capital. They start a business to generate revenue and build a big business. But it is important. It is very important. It is your fuel for your company for the first years. And so the reason I find it important is, well, look, given funding is important, if you treat it with much care, we know that you will do the same with your clients. If you don't care about funding, it's a sideshow, like it takes 2 weeks to answer, then no way in hell you'll answer your clients the same day.
Yeah.
Treat them with great care. If the financial model and the pitch deck to us are crappy, it will be crappy for the client, almost always. And we've seen the best founders, the pitch deck, the quality of the materials. If we ask the question, it was in our inbox the same night, well, that tells you that they will do the same for the clients, and it's the only way you can become successful. So the way they behave, the way they operate, the quality of the materials, it tells you a lot about the quality of the people. And again, the clients are more important than us, but if to us they are really, not up to standard, chances are very low they will do the same with the clients.
Very, very interesting insights. Valuation. Valuation is a hot topic amongst startups, startup founders, and I wanted to know, what is the most interesting thing to you, when evaluating a startup?
So, in the end, like with anything, it's always a question, very simple, of supply and demand. We can put as many metrics as you want, 10 times, 5 times, 20 times ARR. In the end, it's just, if there's a buyer, what is the price is willing to pay? Now, that being said, there are a couple of things I would like to share. Maybe first of all, there's this funny dynamic in our industry that people always want a certain amount of dilution, a maximum amount of dilution. Typically, it's between 15 and 25%. But let's take a very simple example. If you are raising 1 million and people want a standard dilution of, let's say, 20%, well, that means by definition, you want the company to be worth 5 million. Because 1 million, 20% of 5 million is 1 million. Yeah. Now, obviously, the funny thing a bit is, if suddenly you say, oh, you know what, actually, I think I need more than 1 million. I'm going to need 2 million because I have quite some costs I need to make, and I need to probably need to burn some cash to get there. Well, with that same logic, your company certainly would be worth 10 million. That obviously is a bit strange, that you have a higher cost base to get to a certain goal, and then suddenly your valuation doubles. So I appreciate that 15 to 25% or 30% is market standard, but it's a bit funny the way the market works in that sense. In the end, again, it is what your investors will pay for it. And there is also a difference between early stage and late stage. Multiples are typically a lot higher at the seed and Series A stage. Yeah, and it's typically also justified because People tend to focus in absolute multiples, meaning 10 times revenue, which of course in the end doesn't say anything because it's all about profitability in the long run, but it's a good proxy, let's say 10 times revenue. But what typically is forgotten is that there's also a factor of revenue growth. If a company grows 20% a year, well, 10 times revenue is quite absurd. If it grows 100% to 200% a year, well, 10 times could be. I'm not saying it is, but it could be a good metric. There's a difference between industries. Fintech tends to, at least historically, tends to have a higher multiple than an HR company. For the very simple reason that it's tougher to set up a fintech company, so you have a bit more defensibility because you have regulation. You have selling into banks is not as easy as selling to an HR tool to an SME. So there are differences between industries as well. All I can say with valuations is there is a big difference between the early stage and late stage today in the market. I'm talking about the market today. I think at seed Series A, you do get a fair valuation today. I think Series B+, look, it's different because the market is distorted. Some investors, well, have not done so well. I think our dear friends from Japan and another famous hedge fund from the US, they've really propped up the markets. And, well, there is a bit of misallocation and distortion at Series B+. Mm-hmm. At seed Series A, well, actually, we did the analysis last weekend. At seed Series A, we are now at the levels of 2019 of prices. Well, that basically just excludes the crazy 3 years we had. So if you are a founder or thinking about setting up a business, be a bit careful with all the doom and gloom you read in the press. I think seed Series A, it's still healthy and you will get a good price and good valuation if your business is good. I'm not too worried about that. Series B, again, good business do get funded, lower valuations that I did over the past years, but there is a market. So I think there's a lot of doom and gloom sometimes, but I think the market is recovering. You see it, we looked at all the data again over the weekend now, and the market is really bottoming out now. Like from here onwards, I think we've seen the low point. Interest rates start to stabilize. I don't know where interest rates will go, but I don't think they will go much higher from here if you look at the economy. And so stabilization is typically a good indication that things have bottomed out. Let's see how it plays out. I'm quite confident that that now is a very good time to invest and it's a very good time to actually start a business. So yeah, again, we're just at the 2019 level, so I think it's still quite good, you know.
Yeah. And speaking about valuation, who usually drops the first number? Are startups founders expected to sort of tell investors what their valuation expectations are, or is this a conversation you have much later on in the process?
It's always a bit a tricky one and a dance, you know. I think one thing I would definitely say is don't put the valuation in your deck. Don't just don't for two reasons. First of all, if it's too high, it's a turnoff, and if it's too low, I get worried. Like, what am I missing? You know, yeah. Why do you say the business is worth 10 million? I thought I would have done it at 20 maybe. So don't do it. What we do is typically if we like a business, we do in the second meeting or so try and get an indication more or less where you are. If you think, I don't know, you do need to communicate the number that you want to raise. So as I gave the analogy of the 20% dilution, well, if you raise 5 million, we assume it will be somewhere between 18 and 26, you know. We assume, okay, we don't know. But that's typically when we ask, what are your expectations? The best answer is, look, we'll let the market decide. And in the end, that's also what will happen, of course. But be mindful about valuation. Don't overly obsess with dilution and so forth. Just make sure you have the right investor, the right amount of money. It needs to be fair. Right? If you raise 5 million, you don't want to do it at a 5 million valuation to give half away your company. That, of course, also doesn't work. But don't drop the valuation or be very firm on the valuation from the start. There's no point. Obviously, if you have 10 people that want to invest, you do have a bit more leverage in the conversation. But be mindful. Make sure that more or less you're in the same direction. And then we get to term sheet stage. Well, it will be brought up. Most companies tend to agree more or less with the valuation, at least the range when you get at the end stage. So make sure don't wait for it till the end, because if you have 20 million in mind and we think it's 10, then we both lost a lot of time, you know. So the dance start typically after the second meeting, get an indication more or less where you are, and then, well, hopefully at some point we'll get there.
Yeah. And other than valuations, there are other things you negotiate, especially in the term sheet. So when you indicate you're convinced you want to invest, obviously you submit a term sheet to the entrepreneurs. What terms are important to you?
Well, a couple of things on the terms. First of all, every deal is very different.
Yeah.
Previous investors have come in, they've set terms. We, of course, going to build on those, and we're not going to reset everything. Normally not. We have done it, but normally that's not the case. So there are a couple of things very important. Yeah, first of all is it needs to be fair and needs to be balanced. If we buy 20% of the company, we do take the lead and we do want to have a say in certain things. There are a couple of more technical things like liquidation preference and so forth, but I think board structure and preference majority vote are the key things to us. Well, I think, let me maybe digest the two of them quickly for you. So board structure, well, a board is important. Board discusses on the budget, discusses, the most important things of the company. But a lot of things also get covered. A lot of the legal elements of a company get covered in what we call investor majority. And investor majority, it's typically something that is divided between the large investors. So we don't need everyone to vote, not all small angels and so forth. But the large investors typically have, for example, if we have 3 large investors, we say, okay, 2 out of 3 need to agree on certain things before we can do them. Yeah. Very simple example. Well, if the company suddenly wants to raise 1 million in debt, well, we do need to give sign-off from the investors, because that's not really the intention of an early stage company to start raising debt suddenly. Yeah. Secondly, if a company materially differentiates from the budget, meaning if you were to spend, I don't know, just to give a number, 1 million in marketing, and suddenly the founder says, well, I'm going to do 4 million this year. Well, that doesn't work. Like, then the investors need to have a say, okay, we had the budget agreed, we invested on certain expectations, so then we need to have a say in that as well. Now, that being said, if I look at the board and the investor majority, typically when we invest, things are covered quite well, and founders do appreciate that investors want to have a say. And also, you speak constantly. It's rarely that suddenly at the board it gets dropped and then we need to decide yes or no. Typically, it's a conversation that are happening, and then we do find a middle ground where everyone feels comfortable. So I would say a couple of technical things, liquidation preference and so forth. And then we have either we discuss things on the board level, or either we discuss them on the investor majority level with the larger shareholders.
Okay, very interesting. And once this process of negotiating the term sheet happens, obviously you have to verify that everything the startups has done is actually truth, obviously in the due diligence phase. And what are the common red flags you see in the due diligence phase?
Well, so when we do a term sheet, we have done actually most of the diligence already. Typically, when we do the term sheet, we might have another additional call with the client, but we will have done four already. Like, we will have made up our mind. Well, legal due diligence is of course the key one. Financial due diligence is the key one. So legal due diligence, that of course is more driven by the lawyers. And then financial due diligence, well, the numbers that you report, are they real? You say you have 2 million in a bank account. Well, is it real? And so those are the things typically that we do. So we are actually mostly done with our due diligence when we do the term sheet. And then it's more using third parties, again, like lawyers, like financial due diligence partner, like technical partners. So we do work with a firm in many cases that does a bit of technical due diligence, and by technical I really mean like the code, the software and so forth, trying to understand what comes out of there.
Okay. And have you ever dropped off a deal that you thought, oh, this will go in this particular direction during the DD phase? And what is like a typical deal breaker for you?
Well, we once had it, yes, that we found some irregularities in the founder's previous business, which came to our attention in our diligence. That was a turnoff. We decided to stop the deal. That's an extreme example, of course, but it has happened. Well, if the legal documents are really messed up and the previous investors don't want to give away certain rights, which you think are just ridiculous, that can be a showstopper. We've seen companies trying to renegotiate the valuation during due diligence. Also, wouldn't recommend it. Doesn't really help anyone.
Yeah. And how can founders prepare diligently for a due diligence process? What do they need to have in mind while preparing for the
Good question. I think first of all, realize this is gonna eat a lot of your time and energy. It is very, very draining. The diligence process. We've seen it with, typically at seed series A when they do for the first time a larger round, let's say 2 to 5 million. They go in with full conviction, full happiness, and like this is gonna work. And then at the end of the process, all of them are really, really tired. So do know just it's gonna take a lot of mental effort, physical effort, and yeah, you have a business to run as well. So this is gonna be heavy. Secondly, as I mentioned, good materials. I can't stress it enough. Many investors will ask the same questions. So, good pitch deck, good financial model, make an overview of the current client list, what you do for them, make a pipeline, because people will ask for it, so just make it. Market analysis, same story. Make sure the quality is very high, and I would also recommend, and we see it more and more, and that's a very good trend, is what you call a Q&A. Q&A, or a FAQ, indeed.
Frequently asked questions, yeah.
Exactly. The best, we 2 months ago, we looked at the company. The data room was of such high quality that with 2 meetings of 45 minutes, so not that long, typically we have 5, 6, 7 meetings. Yeah, our due diligence was mostly done because all of the hard things that we need to know, what is your pricing model, you name it, all these things, it was so well documented. And it was not 500 pages, the data room, it was just to the point, high quality. Well, it allowed us to really write a very good investment memo. And those 2 meetings, we could really drill down, test them, and then we could bring it to the IC. And then we could invite the founders as well to present to the IC again as well. So within 3 meetings, we were quite comfortable with the decision we made. And I don't want to sound lazy, but there is competition between deals on the IC.
Yeah.
And the better you can help the investors prepare for the IC, the more easy it gets for you.
That's very interesting. I think a lot of entrepreneurs are not aware that there is a lot of convincing that needs to be done only for the investment managers and also as well for the investment committee.
Exactly.
As well. Okay, that is very interesting. And usually once all of this process has gone through, I feel as if from our conversation so far, I feel as if a lot of emphasis is in place on preparing well fundraising documents that can help the investor make a decision as quick as possible. And finally, once you've come to the point that you've decided to invest, you're going to invest and you have to close the deal, what advice do you give them after they've signed the term sheet, the due diligence has been checked out? What do you tell them after? What is the next phase?
After we transfer the money, you mean, or before?
After the term sheet. So after the term sheet, after the due diligence.
Between term sheet and transferring of money.
Yes, exactly.
Well, make sure that things move along. Time kills the deal. The longer it takes, the more time you lose to build the business and the more energy draining and tired people get. So after the term sheet, just make sure that you answer to all the questions of our legal counsel or the investors. Make sure that just things keep on moving and that you can focus fully again on the business. After the term sheet, look, a term sheet typically is a 2-page document that highlights the key economic terms. Then the legal documents, of course, that comes with sometimes extra legal clauses, or you do sometimes need to iron out certain economic points as well. The bad leaver provision and stuff, for example, or the early leaver provision. Well, be very pragmatic about it. Don't negotiate every single thing. By the way, we don't do it either. To be very clear, sometimes it's a bit give and take, and just make sure that you move on. If it's, of course, truly important to you, or you think the VC is doing something completely unacceptable, then of course, keep your ground. But negotiating also means making a very good distinction what's important and what's not. If you have the valuation right, if you have the key terms right, if the board structure works for you and so forth, then just get going, and same for VC, by the way. On our end, I think we're very pragmatic. We're open to everything. No deal is the same. We also know that. And just get moving and focus on the business again.
So you've done very, very well in your firm. I was hoping you could share with us maybe one successful exit story from one of your portfolios.
So yeah, we invested in a company, a healthcare company. We were the very first investor in. It was a company that was it was based out of the UK. They moved to the US now. Basically, we invested at a 2-3 million valuation, very early days, and the company is now doing really, really well. And so within the span of, if I'm not mistaken, 5-6 years, the company has done 38x uptick, and we've been lucky and very fortunate to sell around 40% of our position already. And so yeah, it was a good example again. Good product market fit, good founding team. We were very early. Unfortunately, we invested a little bit later, but nowadays. But yeah, it was just everything came together. Good product, good team, good traction. Another VC that really wanted to have more money into the company offered to buy our shares. We said, well, we do believe in the company still, so we want to keep some part of our shares. But yeah, sure, I think from a risk point of view for the fund, we thought it's maybe good to sell a bit of our shares as well. And so we sold 40% of our shares. And yeah, that was a good return for our investors already.
Okay, that's fantastic. And as a VC investor, what are the biggest challenges or uncertainties that you face moving forward?
Moving forward, well, I think from a macro point of view, well, there is simply exposure to capital markets. If interest rates are high, it's less good for our industry. I also think there's quite a lot of perceived risk in our industry. People think that you invest in loss-making companies, a portfolio, like it's very risky. Well, look, to a certain extent, yes. But that being said, if you looked at what happened over COVID, there are many traditional businesses that went under and software really thrived. So there's a lot of perceived risk as well. But I think capital markets, well, it is a bit of certain times, of course. So that is one part where we have no control on, but it does affect us. Now, for us, what keeps us awake at night is we always want to find the right company. We don't mind. Of course, it's not pleasant, but if we looked at the company, we declined it, and it does well. Well, we're happy for them, but that we can live with. But if we miss companies that we should have seen, then that's not that we don't like that. Then we do analysis like what we can do better. And look, we will never get to 100% coverage. No one does. Not the best VCs in the world do. We try and do as much as we can to see that. So yeah, what keeps us awake at night is trying to find the right companies and making sure that people think of us when they have a great company. Founders reach out directly. LPs, angel investors that were top of mind and people like to work with us. And yeah, that's, I think, the most important part.
Okay, nice. And so far now, you've been doing this for quite some time. You've built a lot of wealth of experience in this particular industry. What has been the most rewarding experience for you in this journey?
Good question. But it's a couple of things. I would say, yeah, first of all, I think on our firm, I find it very rewarding to look at our firm and what we've done, the track record we've built, the LPs we have, and the investments that we made. I think what's really nice about the job is, well, you build a long-term relationship with many of these companies. For some companies, we've been speaking to them, well, yeah, literally 8 years. And it's just very pleasant to see, they were early days. They probably had a deck that was way too ambitious, but they have gone very, very far. And it's very pleasant to speak with them. People, the great founders, they do also recognize the early stage investors, so we still have good connections with them, despite the fact that they have 10, 20, 30 million in revenue and valuations is above 100 millions many times over. And so, yeah, that's quite nice to have a very good relationship with them, see how they progress. Yeah, they do all the work, don't get me wrong, but you were part of the journey. And again, we know very well that the companies, they do all the work. We know that very, very well. But we were happy that we were there and we had a seat at the table, and we were happy to hopefully guide them as good as we can. If we can help them especially on, the big junctions, meaning if they need to make big decisions, if we can be the good sounding board, helping them. It's very rewarding, it's very rewarding. Having those relationships, it's VC, it's very relationship driven. Not only the sourcing, that of course, but also when you invest, having the relationship, because you can be a board member, but if the founding team doesn't like you, well,
Yeah.
you can have maybe certain rights when it really comes to the legal issues, but you need to have a good relationship with them. They need to trust you. Our LPs also call our founders to ask how we behave. So, we have a good relationship with our founding teams, and it's the most important. And I think speaking to them and hearing their enthusiasm and see how we can help, that I think is the best.
Okay. This has been fantastic, Lucas. Thank you so much for sharing these amazing insights on fundraising. I believe many of the entrepreneurs listening to this will get additional insights on how they can further prepare for their fundraising journey. Thank you so much.
Pleasure. And if you are a founder looking for seed, Series A, Series B, please do reach out. We look forward to speak to you, and hopefully we can work together.
Yes, thank you so much. So, dear listeners, I hope you enjoyed this bonus episode of the Fundraising on the Go podcast. Don't forget to tune in for the second bonus episode. Thank you.